So I work with an organization called the Technology Services Industry Association. And we basically work with companies to help optimize service business models. Now, it could be service as a line of business, like professional services or customer success, or it could be when the whole business model is an as-a-service model. And we work with large tech companies, 80% of the Fortune 100 tech companies, and we also work with lots and lots and lots of subscription-based SaaS companies, Salesforce, ServiceNow, a lot of the companies you've heard about. We love data, and we love to find patterns. And we get a tremendous volume of data from all of these companies. We don't just look at the public data. We look at non-public data, and we're looking for patterns. Patterns of success and patterns of failure. What are the best practices to optimize a services business or an as-a-service business? What would be the opposite of best practice? Worst practices? I'm gonna write a book on worst practices, see how that goes. And we've been thinking a lot about where these models need to head. You know, we talk a lot in our companies about skating to where the puck is going to be. And we think in this world of subscription business models, the puck is headed toward profitable subscription-based SaaS, managed service, and other business models. Profitable. Now, the panelists that were just here define profitability as being free cash flow. That's great. That's a metric of profitability. The public markets have a different standard, a gold standard around GAAP profitability. And so we can argue all day long about GAAP, non-GAAP, do I like this, do I not like that? The bottom line is GAAP is the acid test out there right now. And as our companies move, either are public or move toward becoming public companies, we think the question around this business model is ultimately going to be, can it get to GAAP profitability? Can it do that? And how do we do that? So we've been on a journey with the 300 or 400 member companies of TSIA over the last 7 or 8 years. 8 years ago, we wrote a book called Complexity Avalanche, aimed at the tech industry and said, we think we got a problem. We're handing so much complexity to our customers, they just can't onboard it. And if we do that, we continue to handle all that, and we don't drive customers to be successful. We just say, here's all this complexity, good luck. The industry's gonna commoditize. It's a problem. And then we came along a couple years later and said, hey, this is more than just a problem about potential commoditization. There are these new, can we go back, please? There are these new pricing models that customers are gonna love, these new OpEx subscription-based pricing. And the world of selling technology as a product for all this money paid up front, stick the customer on maintenance, and go to the bank, that model's gonna be in trouble. These other pricing models are gonna win the day. A couple years ago, we said, hey, it's more than that. It's a fundamental transformation of tech. These new business models are going to become the standard. This month, we're coming out with a brand new book called Technology as a Service Playbook. And it's focused on this issue of profitable as a service business models. And what do we have to do as a community of companies to get there? What is that going to look like, and how might it look different from the models that many of us are involved in today? We track 2 indexes. One is called the Technology and Services 50. These are the 50 of the largest enterprise tech companies in the world. So this is Microsoft, IBM, SAP, Oracle, those companies. 50 of them. We have a second index called Cloud 40. 40 of the largest SaaS, public SaaS companies. Here are 4 simple metrics that compare the 50 large traditional companies to the 40 cloud companies. The first one I want to call your attention to is the growth rate. Those 50 companies on the upper row together represent $1 trillion in revenue. $1 trillion in revenue. As a group, they're shrinking 4% a year. Look at the cloud companies down below. Those 40 companies as a group are growing at 21%. So the traditional companies shrinking 4%, the cloud companies, SaaS companies growing over 20% as a group. But look at the next metric. Look at the GAAP profitability. Those traditional companies as a group on average are making 18%. The 40 cloud companies on average are losing 4%. You with me on this so far? One other metric I want to call your attention to among the cloud companies, which is the percentage of all their revenue that's coming from their core subscription, their core SaaS offer, okay? Very high, 86%. Just remember that as we go forward. So these models, grow fast, focus on the top line, it's been a beautiful ride. It's been a beautiful thing. And largely the street has been valuing these companies on a very high multiple of revenue. In general, the faster you're growing, the bigger a multiple of revenue you're likely to get from the public markets. But, as you just heard a little bit a minute ago, things are changing. This chart takes these companies, and the gold bar or the orange bar is their revenue of multiple of revenue this year, and the gray behind it was their multiple of revenue 1 year ago. As a group, that multiple is going down. And we think this is not going to stop. And we think there's an inflection point in all of these models where we have to go from a story about high revenue growth, even though it's unprofitable, high revenue growth, to a story that's more of a balanced story. It's a story about growth, but it's also a story about profitability. And investor messaging has got to be able to make this transition, and the company has to deliver on it. There's been a lot of stories this year about companies who tried to talk about this to the street, tried to talk about this to their investors when the slowdown occurred, when the growth rate went from like this to like that. And then they said, hey, the business is looking a little bit different. Good news is we're skating toward, free cash flow, positive. We're skating toward profitability. But they didn't warn in advance, and their stock prices got significantly hit. So there's two things. One is, how do you handle the messaging? And the second thing is, do you do the messaging in advance of what is probably an inevitable moment for most of our businesses? And the third thing is, you got to be able to deliver on this new formula. The problem is, right now, GAAP profits are not happening even at scale. On the right shows the companies in this index that are over 500 million, SaaS companies, over $500 million in revenue. And as you can see, as a group, on a GAAP profit basis, they are still losing money. The traditional tech companies at the same size, virtually all of them, can we go back, please? Virtually all of them at $500 million had significant GAAP profitability. But so far, in these subscription models, that's not showing up yet, right? So why? Why aren't we there yet? At 500 million or 700 million or $1 billion, why are we not yet producing GAAP profits? And what are we going to do to get there? So that was the question. That was the point of this new book, right? What is that journey going to look like? And how do we have to think differently about building GAAP profitable subscription business models as opposed to simply high revenue growth business models? So we went back and looked at what has been driving the phenomenal profitability of the traditional tech companies. The traditional tech companies have been some of the most profitable business models in the history of business models. Why? So we looked at that, and we identified 6 things that we think are central to the profitability of technology-based business models, at least in the traditional world. One is you're able to control your cost of sales to a certain degree. The lower your cost of sales are, the more profits you're going to have. We got that part right. We know that. We know the opposite's also true. The higher your cost of sales, the more difficult it is to have GAAP profits. So one is the ability to get a grip on cost of sales. The second thing we learned is that these companies have diverse revenue streams. Remember the statistic about what percentage of all the revenue of the Cloud 40 is coming from their core offer? 86%. These very profitable companies, they have a diversified revenue streams. They have multiple sources of monetization from their customers. The next thing is network effect. Network effect is simply means that every time you sell a new customer, it makes it better for all the rest of your customers. You know, like when phones first came out, it was the more people that had phones, the more valuable it was for you to have a phone, right? Because you could call more people. Network effect is about making sure that you've got a business model, whether you're becoming an industry standard, whether there's a big labor pool based around your technology, but basically you are creating a network effect. The bigger you get, the stronger you get in the marketplace. Then there's a flip side of that, which is around costs, economies of scale. The bigger I get, the more customers I get, the less I spend per customer, right? The second one is unique capabilities, AKA features. I've got great features and capabilities in my offer, right? Now, most people say, well, wait a minute, that should be number one, right? In the tech industry, we're all about features. Features should be number one. But when we looked at these companies, these drivers of high profitability, the number one was high customer switching costs, right? You can use the word churn, you can use the word customer success, but these companies found ways to be able to keep their customers on board. Now, SAP, as an example, has a slightly unique capability, which is it's impossible to rip out their product, right? That is a legitimate strategy, right? But the bottom line is these companies monetize their customers consistently in diverse ways over a period of time. So when we looked at the traditional tech companies, these highly GAAP profitable companies, against these 6 attributes, they did pretty well. They scored high on 3 of the 6, they scored medium, and the one they didn't score too well on was they still have pretty high cost of sales, right? The famous Oracle Salesforce or the Cisco Salesforce. They still had pretty expensive sales costs. But then we said, geez, I wonder if we took the current, what we call the SaaS 1.0 business model, and we applied it to the same set of standards. And when we did that, and we try to be very objective about this, we found that the current SaaS business model against these economic moats was either the same or worse, smaller economic moats on all 6 things. So I want to talk about 2 of them that you, as the customer success leaders in your company, are right square in the middle of. In order for us to skate to GAAP profits, we've got to improve our performance against some of these traditional levers for driving high profits. The first one is one we've talked a lot about, the cost of sales problem. When we look at the industry, see those 2 red bars? The licensed software, so that's traditional software companies, SAP, Oracle, Microsoft, those companies. They're currently spending 29% of revenue on sales, okay? The SaaS companies in our index are spending 40% of their revenue on sales. Salesforce, the biggest SaaS company, is spending 52% of its revenue on sales costs. It's hard to drop GAAP profitability when you're spending 40, 50, in some cases 100, 200% of revenue on sales costs. Now, to save us is the famous SaaS revenue waterfall. Because as you've heard many, many times, it's the existing customer base that is generating most of the revenue once you get to a critical mass. And so we don't have to live with all of the revenue coming at a huge cost of sales. We can have some revenue coming at a huge cost of sales, but thanks to the customer success function, we can deliver lots and lots and lots of revenue for our companies at a much reduced cost of sales. And we all know how to do that, right? TSIA, we coined the term layer, land, adopt, expand, renew, right? We all know this well. Sales has to go out and land a new customer. That's an expensive activity. But then we're going to put them on a platform, and that platform is going to be loaded up with analytics to understand exactly what each customer is doing. Are they healthy, not healthy, what we got to go do? That's going to drive a set of activities in the customer success organization and the customer service teams. And ultimately, we're going to have expand and renew capabilities that are a fraction of the cost of the selling, the landing of the customer. And we're going to blend that all together, and we're going to, over time, drive down this high sales and marketing spend. I don't know that we can ever get to single digits or 20, it's probably not realistic, but we can bring it down from where it is. And that's essential to achieving GAAP profitability, and customer success is truly at the center of that whole conversation. You know that. But I want to talk about another thing that customer success needs to be at the center of, which is this notion of revenue diversification. When we looked at these companies, we found some patterns. Patterns of behavior, patterns of communication, patterns of financial performance. And we created 3 categories, which we believe you can call them a maturity model, states, whatever you want, but stages that subscription business models like SaaS and managed services go through over a period of time. And those stages can be evidenced by some behaviors and some facts. One is, do those companies know what the key unit they're trying to fix on is? Are they trying to fixate on clicks, customers, page views, transactions? What are they going to ultimately monetize? Do they know what that is? And do they have a way to grow that at scale? Second thing is, are they confident in their revenue model? Do they know how to price those units? Right? Do they know how to transform volume of transactions or volume of users into volume of revenue? Do they have a mature model for doing that? The third is, what's growing faster, their revenues or their expenses? And the last one, which you heard a little bit about earlier, is what's the profit horizon? What are they messaging to the street? What are they talking about internally in terms of when the business model is going to hit this inflection point of profitability? And we found these 3 stages, these 3 patterns. The first one we call a future value aggregator. And what that means is you are just trying to get these units of future economic value onto the platform. You are just trying to get customers onto the platform. You're just trying to get transactions to happen, right? You may not even be monetizing them. You may be giving them away to prove your product market fit to get the customers on the platform. Monetization may be something that's going to occur a little bit later on. Once you get a bunch of those customers, now we're going to offer premium offers and other things to begin to monetize them. So the profit point in this chart, the solid line is revenue, the dotted line is expense, and guess what you call the white space in the middle? Losses, right? Right? There's a loss period. It's an extensive loss period. It's 6, 7, 8 years of losses that are going to get funded somehow, some way. Venture capital, whatever it is, right? But our priority is rapid growth in whatever the unit is, whatever we believe we're going to monetize in the future. We need rapid growth of those units. You know, Twitter might look at how many subscribers, or Pandora might look at how many plays, or you might look at how many customers have signed up for the platform. We need rapid growth, triple-digit growth of that. Maybe we're not so confident in our pricing model. We're still working that through, right? Revenues are definitely not growing faster than expenses. And the profitability horizon is out there, right? Then there's another phase. We call it the midterm wedge. Now you've got to start to prove that you've got an economic model that is ultimately going to work, that you can get a grip on both revenue growth rates and expenses. And you've got a model that says, in a reasonable period of time, 3 to 5 years, those two lines are going to cross. So maybe we're not growing at triple digits, but we're growing at high double digits. But we know what the business model is. We know what our pricing is. We know what the portfolio needs to be. And our revenues are now starting to grow faster than expenses. We haven't hit profits yet, but we can begin to see the long-term business model take shape. And the third stage is a current profit maximizer. You are nearing the inflection point. You are either at GAAP profits or you're nearing GAAP profits. And in this case, the growth could be slowing, but the messaging is changing to the street. We're growth plus profits, not just growth. We have got multiple strong monetization engines with our customer base. We've got very, very clear path to profitability, and we're confident enough in that path that we're starting to message it. And we're messaging it in advance of potential revenue growth rate slowdowns. Now, here's where it gets interesting. We talk a lot in this industry about friction, right? Reducing friction for customers, making it easy for customers to get on the platform, making it easy for them to get to value. That's a great concept, especially if you're this early future value aggregator. Easy is good. You're just trying to get customers on the platform. You may not be making any money at them, but you're getting them on the platform. But there's another side which says, I want to have the most profitable economics per customer I possibly can. I want to maximize the margin. Those two can be competing thoughts. Do I reduce friction, make it simple, bundle everything together, get a lot of customers, but not really make much money per customer? Or do I want to have maybe a little more friction, right? A little harder decision, a little more complex offer, a little more monetization. The reality is future value aggregators are going to choose low friction. They're going to choose easy purchase, even if it means not great customer economics, because that's their stage. But what's important is that they're not going to stay in that stage. Over a period of time, we have got to learn to put strategies in place that drive up our per unit economics so that we're monetizing customers more aggressively. The friction will probably go up as you mature. What does that mean? That means your portfolio and your pricing, as you move through these three phases, has got to grow. It's got to change. It's got to mature. Your customer engagement model has to grow, it has to change, it has to mature. Your financial models have to grow, change, and mature. Carrying forward the future value aggregator market thinking for 10 years is not a strategy that's probably going to get us to GAAP profits. We have to know there's a starting point and there's an evolution. Our offers, our pricing, our adopt, expand, renew models, our revenue mix, our margins have got to evolve as we go on the journey as subscription businesses through these three phases. So when you look at the P&L of these companies and you say, geez, how do we make money, right? Where do we think about the monetization of this to get to GAAP profits? Well, look, there are primarily 5 kinds of revenue in the world today. There's your core subscription revenue. There's any annuity account services that you can put on top of that. You can put on top premium customer success services or data services or other things that you charge on an annuity basis. If you have an implementation motion, a professional services motion, you can charge for that. And if you have transaction revenue, transaction that go on top of your subscription, or maybe it's all of what you do, you can charge for that. We went out and looked. What's possible today? What kinds of margins are being achieved in these different revenue streams? And we began to see a journey where you say, I'm a future value aggregator, I'm about low friction, I'm just going to have my core offer, I'm going to bundle in tech support and basic customer success. And I'm going to make it easy for customers to get on the platform, succeed, and I'm going to grow, grow, grow. And then you say, that's an unprofitable business model because I have all my revenue coming from a high cost of sales. I don't have much revenue diversification. 86% core subscription. But what happens to core subscriptions? They get squeezed by competition. It's never been cheaper to build software than it is today. Your core subscription gets under pressure quickly. But if you say, I'm going to go on a strategy of diversifying my revenue streams, not putting every feature into the core offer, but now I have my second module, my third module. I'm going to sell them differently. I'm not just going to have free customer success. I'm going to have premium customer success that I'm going to charge more for. And then you move into a stage where I can drive not all my revenues at high cost of sales. I've got multiple revenue streams with different economics, and they can add up to at least a break-even business. Then you go to the final stage, and you say, I have a diverse revenue stream. I've got multiple offers in my portfolio. I'm charging for services. I'm charging for success. A lot of those offers are offers around the touch points that you have with customers and monetizing those touch points and being aware that what you did as a future value aggregator, simple, free, that kind of stuff, is probably not the ultimate journey. We're still going to have that, but we have to move to more consultative customer success services, premium services, information services, data services, because our customers are a captive audience. I know that sounds mean, but it's true, and it's important as we think about skating to what we believe can be a 20-point gap business. A 20-point gap business. We think there's a 2.0 SaaS model where we have strong economic moats on all of these areas, where we are yellow or green across the board on the things that have proven for so long to become gap profitable in a very significant way. Customer success plays a central role in the SaaS 2.0 gap profitable model that we think everybody is going to have to skate to at some point in the future. You are on the hook for driving down sales costs in a lot of these subsequent revenue streams, optimizing the economic performance of the waterfall, and monetizing multiple service offers on top of the core subscription. We talk a lot about adoption and NPS, customer success. That's important, but it's not the whole story. You are central to the economic engine of a gap profitable subscription business. Thank you very much.